This section is going to cover a lot of rules as they relate to customer accounts. FINRA requires that all member firms maintain a minimum amount of information anytime they open up an account. The overarching general rule that FINRA has when it comes to books and records is that unless a specific FINRA rule says otherwise, member firms shall preserve for a period of at least 6 years books and records for which there is no specific period of time to keep it. So the default period of time is going to be 6 years. You're going to see throughout this section there's going to be a lot of numbers. Different things have to be kept for different periods of time. So account rules and regulations pertaining to record keeping of documents, a lot of numbers. So if we don't say a specific number as it relates to records, the default is 6 years. If it's records related to a customer's account that doesn't have a specific period of time, we said the default is what? 6 years. 6 years after the date the account is closed. Otherwise, the retention period is 6 years from the time in which the books and records are made. So whichever is longer, of course. Books and records that are required to be maintained, whether or not they're required to be maintained under the Securities Exchange Act of 1934 or under FINRA rules, can be preserved in a format of whatever the broker-dealer chooses. So historically, there was a bunch of paper, but that's not required anymore. It is perfectly allowable for the member firm to use electronic storage media for their books and records. They could use paper if they wanted to, but if they choose to use electronic storage media, Securities Exchange Act rules require that the information is retained in a non-rewritable and non-erasable format for whatever the time period for the record is. Records must always be made available promptly upon request. So microfiche, electronic data, microfilm, who uses that anymore? The firm does not have to back up electronic records with paper. That would be silly. What would be the point of that? So they do not. Just non-rewritable, non-erasable format. Different kinds of accounts your clients can have. So you're servicing your client, and your client, let's say, is Bob Smith. So he has an individual account. So one person's name is on there. So most accounts that you will be opening will be individual accounts. Bob, your client, has told you that he would like to make sure that his daughter Sarah gets his assets, his financial assets, when he dies. And he's wondering what's the easiest way to do that. What he wants to do is he wants to put a TOD, which is a transfer on death, or we'll call it a POD designation. So a TOD, transfer on death, or POD, which stands for payable on death designation, can be done on most financial accounts. So basically, it's like naming a beneficiary. So he said, I want to make sure that when I die, my daughter Sarah gets these assets, but I don't want Sarah to have access to the assets while I'm still alive. So no joint account would not be suitable in this story. So if Bob has Sarah listed POD or TOD upon Bob's death, all she would have to do is show his death certificate, and the account would be transferred into her name. So it's a very easy way to make sure that checking accounts or savings accounts or brokerage accounts, mutual fund accounts, go to someone. The POD or the TOD designation does live outside of a person's will. So it's important to understand if Bob's will, everything goes to his son Marty, everything goes to Marty, but Sarah's listed on this mutual fund account, this asset will go to Sarah. So it does stand up outside of a person's will. Not all states allow POD or TOD designations, but most states today do. So I would be familiar with them for the test. What if Bob wants to have an account with his wife, Mary? So now we have a joint account. So now we've got Bob and Mary Smith. We've got two different types of joint accounts that we need to understand. So joint accounts. For sure, questions always on these. We have joint tenants with right of survivorship. This is the most common joint account designation that you will find when you have a husband and wife. When you have two people that want to own the asset equally. So two or more people, it could be more than two, but this is really important, that the ownership of this asset is equal. So when you have joint tenants with right of survivorship, both parties are on the account, the asset is owned equally. If Bob passes away before Mary, the asset becomes Mary's. So all of the asset passes on to the surviving account owner. Probate is avoided. Joint tenants with right of survivorship. How about this story? You have a client, you've got two brothers. You've got Chris and Kevin, and they're building a vacation home. And Chris is going to put in 60% of the money, and Kevin's going to put in 40% of the money. And remember, they're brothers. The asset is going to be owned unequally. So we can't do joint tenants with right of survivorship. This time we have a joint account called tenants in common. So tenants in common is a designation you can have on a financial asset whenever your clients want to own an asset with unequal ownership. Unequal ownership. So if Chris should pass away, his interest will go to his estate. So his family will retain the 60% ownership in that vacation property or in that financial asset. So tenants in common is a type of a joint account when you have two or more people and the ownership is unequal. The asset does not pass on to the survivor. If your client wants that, it's joint tenants with right of survivorship. You can have an account for a trust. So the person that establishes the trust is called the grantor. So parties in a trust. The grantor establishes a trust. So a trust is a legal entity that holds title to property. There's various different reasons why people might use a trust. If it's an irrevocable trust, it gives the client asset protection. It can be used to preserve a family business. It can be used for estate tax planning purposes. So lots of different reasons why people might want to have a trust. So the grantor establishes the trust. The trustee manages the trust assets. And the trust is set up to benefit the beneficiaries. And there's, so much more to trusts than you'll see on this test. Usually you want to have an accountant's advice and a lawyer draft the trust properly so that it will hold up in a court of law, since a lot of them are done for asset protection. But we can use them when a beneficiary is underage or mentally impaired as well. You can have a trust that's created while the donor is alive. That's called a living or intro vivos trust. You can also have a trust that is created upon a person's death, which we call a testamentary trust. You can also have an account where an asset is owned for a child. For example, my oldest boy, Miles, when he was little, I got him 1 share of Pixar. Because I'm that kind of mom, I buy stock for my kids for Christmas. So he has 1 share of Pixar. He is still a minor, so he can't own the share himself. He actually owns his share of no longer Pixar, because Disney, of course, bought Pixar. He owns them in a UGMA or UTMA account. So depending upon what state, so UGMA, Uniform Gift to Minors Act, UTMA, Uniform Transfer to Minors Act. This is an account that is set up for the benefit of a minor. So the minor's social security number is used. There is 1 minor per account, and there's 1 custodian per account. So I'm the custodian on his UGMA account for the benefit of Miles Rhodes. His social security number is used. Now, UGMA states the asset in this account can become the child's as early as age 18. The asset in a UTMA state can become the child's as early as age 21. So states are different. That's the major difference between UTMA and UGMA. It's a gift. It's irrevocable. The custodian has all management obligations. The custodian can use the assets for the benefit of the child. The custodian who is the donor as well cannot charge a custodian fee. The shares are registered to the beneficiary upon reaching age of majority, 18 or 21. Custodian for the minor. So Susie Rhodes, for the benefit of Miles Rhodes, is the title for that account. And there's no limit to how much money I put into UGMA or UTMA account. It's a gift to the child that is irrevocable. Now, don't confuse that with the fact that every year there's a gift tax exclusion amount. So how much can you gift under the current year's gift tax exclusion amount is covered in a different section. So if I gift a minor more than the gift tax exclusion amount, I, the person giving the gift, owe gift tax. Something else just to remind us of, when you have a UGMA account that owns securities, those securities have unearned income. Now, within the current year's contribution limit video, I discuss the idea of the kiddie tax rule. But just as an overview, unearned income in a UGMA or UTMA account is taxed at the parent's marginal tax rate. The marginal tax rate is the tax rate you pay on the last dollar you earned. So the last dollar you earned is subject to the highest income tax rate. So the IRS wants to make sure that wealthy clients aren't putting their investments in their child's name. So we have this, it's a little more complicated when you do that section as far as the kiddie tax rule goes, but just as an overview, unearned income is taxed at the parent's last dollar tax rate, marginal tax rate. So we talked about individual accounts, accounts for children. We talked about joint accounts. Now, your client is traveling and they've asked you to hold their mail while they're going out of town. So broker-dealers are allowed to hold their customers' mail. So the rule works like this. How long can a member firm hold a customer's mail? So if the customer is traveling in the United States, another way they'll say that is domestically. There's 2 words here that helps me remember United States. The mail hold rule says the broker-dealer can hold the client's mail for 2 months, United States. If they're traveling outside the United States, so if the customer's outside the US, then we take the 2 months, we add a month. So the mail hold rule, if the customer is traveling outside the United States or internationally, they might say on the test, you can hold their mail, the broker-dealer can hold their mail for 3 months. I know it sounds weird because usually the post office holds mail, but the actual broker-dealer can hold the customer's mail for 2 months if the client is traveling in the U.S. and for 3 months if they're traveling outside the U.S. All broker-dealer firms must have an anti-money laundering compliance program. So, money laundering, the disguising financial assets so that they can be utilized without detecting the illegal activity that produced them. Through money laundering, proceeds from illegal activities may be transformed into funds that appear legal. It just sounds bad. So firms have to have procedures in place to look out for such an activity. It's FINRA Rule 3310 that talks about member firms must develop and implement a written anti-money laundering program reasonably designed to achieve and monitor the members' compliance with the requirements of the Bank Secrecy Act, as well as implementing regulations written by the Department of the Treasury. So we've got anti-money laundering programs. All member firms must have it. So the first regulation we mention is the Bank Secrecy Act. Each member's anti-money laundering program must be approved in writing by a member of senior management. So program approved in right. So someone's saying, I've looked this over. This looks like we're doing what we need to do. The anti-money laundering program required under FINRA Rule 3310 must, at minimum, establish and implement policies and procedures that can be reasonably expected to detect and cause the reporting of certain transactions that I will describe in a moment. This idea of activities that seem a little off, suspicious. The program must establish and implement policies, procedures, and internal controls reasonably designed to achieve compliance with the Bank Secrecy Act. The program must provide for an annual, so on a calendar year basis, independent testing for compliance to be conducted by member personnel or by a qualified outside party. So calendar year basis, with some exceptions as far as some firms can do it every 2 years, but we're going to worry about the annual calendar year independent testing. So test the program annually. Test program. Make sure it's still doing what it was set up to do. Member firms must designate and identify to FINRA by name, title, mailing address, email address, telephone number, and fax number an individual or individuals responsible for implementing and monitoring the day-to-day operations and internal controls of the anti-money laundering program. The person named must be an associated person of the member. The member firm must provide prompt notification to FINRA regarding any changes in the designated person or persons. The program must also provide ongoing training for appropriate personnel. The rule is annual testing of the program, with slight exceptions that will allow every 2 years. However, if circumstance warrant, a firm may be required to test their program more frequently if necessary. The person conducting the testing must be someone that has working knowledge of the requirements of the Bank Secrecy Act and any implementing regulations. Independent testing can be done by someone from within the firm or outside the firm. If they're within the firm, the testing cannot be done by a person who performs the functions being tested. Of course not. It'd be easy to lie about how well they were working. They cannot be done, the independent testing, by the designated anti-money laundering compliance person or by a person who reports to either of those people. FINRA rules require that each member identify, review, and if necessary, update the information regarding its anti-money laundering compliance person. When? Promptly, but in event no later than 30 days following a change. So we've got a contact person. So FINRA knows the contact person. FINRA knows the firm's contact person, which is an associated person, must be by law. And then if this contact person changes, what's the rule say? You must tell FINRA when? Promptly, but in no event later than 30 days following the change. It's also required that member firms review contact information quarterly annually, sorry about that. So every year, not NASD, but it's an NASD reference within the rules still, FINRA, sends a notification out to all member firms that say, hey, don't forget, you're required annually to review the contact information that you have provided us. One of the people that they have provided is the contact person for the Anti-Money Laundering Compliance Program. When? They have to review it and change it if necessary within 17 business days after the end of the calendar year. If FINRA should ask for any information from the member firm in regards to contact persons, the member firm shall reply promptly, but in event no later than 15 days following the request. So just to review, because I don't want to confuse you, there's a rule about contact person information. And the first one really that we've talked about is the anti-money laundering contact person, compliance program contact person. So if that should change, FINRA should be notified promptly within 30 days. But then every single year on an annual basis, now this is not the only contact person FINRA has, the firm will review. Of end of calendar year. Within 17 business days. So sometimes they'll pick on what kind of days, so I have to make sure to mention it. If it's specified in the law, I'll always mention it. Within 17 business days of the end of the calendar year. So it's usually an email the firm gets from FINRA. So anti-money laundering rules have been around for a long time. The Bank Secrecy Act is not new. However, the Bank Secrecy Act was amended by the USA Patriot Act. So after 9/11, we strengthened the Bank Secrecy Act, added a lot of new things. So we have, after 9/11, the USA Patriot Act. So it actually stands for, it's a big bunch of words, but it's kind of interesting because I think people just assume it stands for the United States of America, but it actually doesn't. It stands for Uniting and Strengthening America by providing appropriate tools required to intercept and obstruct terrorism. The act was passed in 2001. Designed to increase financial institutions' ability to prevent, detect, and prosecute international money laundering and the financing of terrorism. So the Patriot Act amends the Bank Secrecy Act. It has different sections that are referenced on the examination content outline. Once again, it's not a matter of what does Section 314 do, it's know the content in the section even if I reference the section number. So Section 314 talks about this idea that there's lots of people involved in an investigation or in the compilation of information about these sorts of activities. So financial institutions must cooperate with, right? We must all get along. So Section 314 helps law enforcement identify, disrupt, and prevent terrorist acts and money laundering by encouraging further cooperation amongst law enforcement, regulators, and financial institutions as far as sharing information regarding those suspected of being involved in terrorism or money laundering. So we've got to all work together on this huge problem. Section 352 is the anti-money laundering program. So the FINRA rule was about broker-dealers, and then this is a rule for all financial institutions. So Section 352 requires all financial institutions establish anti-money laundering programs, which at a minimum must include the development of internal policies, procedures, and controls, designation of a compliance officer, an ongoing employee training program, and an independent audit function to test programs. So what this USA Patriot Act really did is it introduced two really important forms that must be filed. So under the USA Patriot Act, we have currency transaction reports and suspicious activity reports. So we commonly call these CTRs, currency transaction reports, and we commonly call these SARs or SARs. Financial institutions file these reports with what is called FinCEN. So FinCEN stands for the Financial Crimes Enforcement Network. So these reports are filed. It's part of the Department of the Treasury. Reports filed with FinCEN. Financial Crimes Enforcement Network. The reports today must be filed electronically when? Within 15 days following the day on which the reportable transaction occurred. So within 15 days. So electronically. Now, these time periods sometimes change. So this is a shorter time than it was historically. Within 15 days, filed electronically, of course. Now, there's also a rule that financial institutions must keep a copy of every report filed for 5 years from the date of the report. So kept for 5 years. Reports kept. All of these numbers. So this is going to take some practice. So reports kept by the financial institution, because remember, FINRA rules are for broker-dealers, but the USA Patriot Act is for banks, check cashing places. It's for any financial institution. Insurance companies have to follow these rules as well. So what requires the filing of a currency transaction report? Every cash transaction that exceeds $10,000. So currency transaction reports are filed for cash transactions greater than $10,000. This includes the transfer of funds electronically the purchases of a bank CD, the purchase of securities, so stocks, bonds, any other investment. The Act also requires the reporting of wire transfers in excess of $3,000. So that's kind of a separate rule. So wire transfers greater than 3 must be reported as well. Greater, which is interesting. Think of how often those must have to be reported. So wires greater than $3,000 are required to be filed. And even this, cash transactions that exceed $10,000. So the purchase of investments of more than $10,000 require, it's not that somebody's doing something wrong, it just requires the filing of a currency transaction report.